Money is the only subject every single person on earth deals with, every day, and almost nobody is ever taught how to think about it. We treat it like math, spreadsheets, interest rates, percentages, something you'd solve with a calculator, not a therapist. But your financial decisions aren't made in a spreadsheet. They're made at the dinner table, in a moment of fear, in a flash of pride, shaped by things that happened to you or your parents, long before you opened a bank account. By the end of this video, you'll understand why some people earn millions and still end up broke, while others build real wealth on an average salary, quietly, without anyone noticing. That's the idea behind one of the most talked about finance books of the last decade, Morgan Housel's The Psychology of Money. Its case is simple and a little uncomfortable. Doing well with money has very little to do with how smart you are, and everything to do with how you behave. Imagine two people, one born in 1950, one in 1990, both smart, both hardworking, both reading the same news. But the 1950-born investor spent their 20s watching markets crawl sideways while inflation ate their savings. The 1990-born investor grew up watching markets mostly climb. Ask both, should I trust the stock market? And you'll get two completely different, completely rational answers, not because one is smarter, but because they were handed two different worlds. We don't decide from a spreadsheet. We decide from our own life story. Nobody's financial choices are stupid, given what they've lived through. Your relationship with risk and saving was written before you had a say in it, by the decade you were born into, and the money habits you watched at home. So next time someone's money decisions seem baffling, the coworker who won't invest a cent, the friend who won't stop buying lottery tickets, you're not looking at a stupid decision. You're looking at a different life. To see how this hidden force plays out in the real world, look at what happened in 1968. In 1968, a private school outside Seattle called Lakeside did something almost no high school on earth had. It got its students access to a computer terminal, back when even most university students never touched one. One kid who got hooked on that machine was a 13-year-old named Bill Gates. Brilliant, obsessive, driven, no argument there. But also one of a tiny handful of teenagers on Earth with early hands-on access to computing. He said outright, without that school, there's no Microsoft. There's a second name almost nobody knows, Kent Evans, the third member of that same tiny computer club. By most accounts, just as sharp. Right there with Gates from day one. He might have been a Microsoft founder, but he never got the chance. Evans died in a mountaineering accident before he even graduated. Same school, same rare opportunity, same raw talent. One path built one of the largest fortunes in history. The other ended before it began. Be careful who you envy. Be careful who you blame. Luck and risk are the invisible twins riding along with every outcome we see. Be slower to worship success as pure genius, and slower to write off failure as pure stupidity. How much money would actually feel like enough to you? Most people, honestly, don't have an answer, and that's dangerous, because without a finish line, the goalposts just keep moving. You hit the number you once dreamed of, and almost instantly, it stops feeling like enough. The most extreme case studies in the book aren't broke people. They're men already worth hundreds of millions, who committed fraud chasing numbers that meant nothing to their actual quality of life. Everything to lose, and something in them still needed more. The hardest financial skill is getting the goalpost to stop moving. Ambition is fine. The real lesson is deciding, in advance, what enough looks like for you. Because if you don't set that number yourself, your brain will keep raising it, forever. Warren Buffett is worth somewhere around $100 billion. The number that stops people cold. The overwhelming majority of that fortune was built after he turned 65. He wasn't just a good stock picker. He was a good stock picker who started at age 11 and never stopped for 8 decades. The skill is real. The secret weapon was time. Picture a version of Buffett who only got serious at 30 and retired at 60. Same extraordinary annual returns. And he'd have ended up with well under 1% of his real fortune. 3 fewer decades of compounding. And the results are almost unrecognizable. Compounding doesn't feel intuitive, which is exactly why we underestimate it. Our brains think in straight lines. Money grows in a curve that looks flat for years, right up until it doesn't. The single most underrated ingredient in almost every fortune isn't genius. It's time left uninterrupted. Getting money and keeping it are different skills that sometimes need opposite instincts. Getting takes big swings, optimism, risk. Keeping takes something closer to the opposite, humility, and a healthy fear of losing it all. Rick Guerin was a lesser-known third partner, alongside Warren Buffett and Charlie Munger in their early years, arguably just as sharp a stock picker. But Guerin used borrowed money to juice his returns. When markets crashed in the 1970s, margin calls forced him to sell his Berkshire shares for a fraction of what they'd eventually be worth. Buffett and Munger, unleveraged, didn't have to sell a single share. They just had to survive the storm. You only need to get rich once, but you can go broke more than once, so play as if you might. That's the whole idea. Staying in the game through the bad years beats any single brilliant decision. And that's exactly why the smartest plans build in a cushion for when, not if, something goes wrong. More cash on hand than a spreadsheet says you need. A spreadsheet can't model panic. The tortoise doesn't win by being fast. It wins by not dying. Heinz Berggruen fled Nazi Germany and became one of the most successful art collectors in modern history, eventually selling part of his collection for well over $100 million. But most of what he bought over his lifetime was, frankly, forgettable. His fortune wasn't built on being right every time. It was built on buying a huge volume of art and letting a tiny handful of pieces carry the entire portfolio. Amazon's growth is disproportionately carried by essentially 2 ideas, Prime and AWS, while plenty of other experiments quietly failed. Venture capital runs on the same math. Most startups go to zero, but the one breakout success pays for every failure combined, many times over. You can be wrong most of the time and still come out way ahead. Even Buffett is wrong in some sense on most of the hundreds of stocks he's owned. What makes him rich isn't a perfect average. It's staying in the game long enough for a few enormous winners to do the heavy lifting. See someone driving a brand new luxury car. What do you assume? Most people's gut says, that person must be rich. Flip it around. That car is proof they spent money, which by definition is money no longer theirs. It tells you almost nothing about their bank account. It might just as easily mean they're leveraged to the edge. This is the gap between rich and wealthy. Rich is visible. The car, the watch. Wealth is invisible. Assets never converted into things. Still compounding. Still giving you options. Wealth is the nice cars not purchased. The upgrades declined. You can't see someone's restraint. Only what they chose to buy, never what they chose not to. Every rich-looking lifestyle you admire might be telling you the opposite story of the one you assume. You don't need a specific reason to save. Not for a house, not for a car, just saving. Because the future is unpredictable, and a pile of savings is your buffer against everything you can't see coming yet. Ronald Read was a janitor and gas station attendant who lived modestly, quietly investing small amounts for decades, and died with a portfolio worth around $8 million. No insider tips, no genius picks. He just spent less than he earned, invested the gap, and let time do the rest. Your savings rate is something you control completely. The market's returns are not. Your income and your returns are largely out of your hands. Your savings rate, the gap between what you earn and spend, is entirely yours. It's the one lever you get to pull every single day. And underneath all of it is the real prize, the freedom to control your own time, which is the actual dividend all this saving and compounding is buying you. Managing money well isn't really about intelligence, not the right formula, not picking the perfect stock. It's about behavior, patience, humility, restraint, and staying in the game long enough for time to do the heavy lifting. Nobody's choices are crazy once you understand the life that shaped them. Luck and risk are always riding along, and the goalposts keep moving unless you decide where they stop. If you want more breakdowns like this one, subscribe, and I'll see you in the next video.